In Canada, it's almost time to file your taxes, and you're probably looking for some strategies to help you save some money. The 4 strategies that we're going to go over are registered accounts, spousal RRSPs, claiming capital losses, and spousal loans. If you're new here, I'm a certified financial planner and a tax and estate planner. Over the past decade, I've helped my clients grow their wealth through investments, tax strategies, and financial planning, and I'm here to share those tips with you. If there's something specific that you're interested in, feel free to skip to that section below. Welcome back to Tea with Aditi, and let's dive right in. Number 1, registered accounts, RRSPs and TFSAs. One of the significant advantages of contributing to the RRSP, which is the Registered Retirement Savings Plan, is the tax savings it offers. When you contribute to the RRSP account, the contributions that you make are deducted from your income for that year. This means you'll pay less income tax in the current year. For example, if you live in Ontario and your annual income is $75,000 and you decide to make a contribution of $5,000 towards your RRSP account, your tax bill would go from $14,435 to $12,953, saving you $1,482. Some of the advantages of contributing towards your RRSP are immediate tax benefits of reducing your annual taxes and the ability to grow your account tax deferred until you decide to withdraw funds from that account. This means that the growth in your RRSP account is not taxed annually. It is important to note that when you do make withdrawals from the RRSP account, you have to pay taxes on the withdrawals as if it were income for that year. The idea is that you're going to make the withdrawals in your retirement when you're in a lower tax bracket than you would be in today. The other registered account is the TFSA, which is the tax-free savings account. One of the primary benefits of the TFSA is the tax-free growth that it allows. Any income earned within the TFSA, whether it's from investments, interest, or capital gains, is all considered tax-free. And the best part is that when you make withdrawals from the TFSA account, those are also considered tax-free. So basically, you get to keep every penny of what you earn without having to worry about the taxes. Every year, you're allowed to contribute a certain amount to your TFSA, and for 2024, that amount was increased to $7,000. It's important to note that these contribution limits are cumulative, so if you don't contribute this year, that room does carry forward and you don't lose it just because you don't get to contribute. If you have never taken advantage of the TFSA account, but you've been eligible for it since inception, your contribution limit as of 2024 would be $95,000. Number 2. Spousal RRSP. This is different than contributing to your regular RRSP account. A spousal RRSP allows a higher earning partner to contribute to an RRSP account in the name of their lower earning partner. Here's how it works. Tom and Mary live in BC. Mary is a higher earning spouse and she earns $140,000 a year. And Tom is a lower earning spouse and he earns $60,000 a year. Mary decides to contribute funds to an RRSP account in Tom's name. Any contributions that Mary will make to the spousal account will reduce her own income just like a regular RRSP. So in this case, if Mary decides to contribute $25,000 towards the spousal RRSP account, it will lower her annual income from $140,000 to $115,000, therefore reducing her tax bill from $36,613 to $26,734. Now, in the future, when retirement approaches and Tom decides to make withdrawals from the spousal RRSP account, any withdrawals will be taxed in Tom's hands instead of Mary's hands, which is beneficial because Tom is likely in a lower tax bracket than his higher earning spouse, Mary. It's an excellent strategy to income split, potentially lowering your tax burden as a couple. Plus, it's a great way to ensure that both the spouses have income during retirement, especially if one didn't get to work as much or had to take time of absence during their working years. Number 3, claim capital losses. Capital losses occur when you sell a capital property such as stocks, real estate, or other investments for less than its adjusted cost base. So basically, if you're selling at a loss. In Canada, you can claim those losses against your taxable income for that year. You can use your net capital losses to offset any taxable capital gains in the current year, in the 3 preceding years, or any future years going forward. It is extremely important to maintain any documentation from the sale. Number 4, spousal loan. In Canada, individuals are taxed based on their income level. By utilizing a spousal loan, a higher earning spouse can loan money to the lower earning spouse. The purpose of this would be that the lower earning spouse will get to invest that money, and any earnings from it will be taxed in the hands of the lower earning spouse. This loan is done using the prescribed interest rate that is set by the CRA. Before we go on to discussing this any further, I want to mention that this strategy used to be much more beneficial a few years ago when the interest rate was much lower. Let's consider an example. Meet Jack and Jill. Jack is a higher income earner and Jill is a lower income earner. To optimize their tax situation, they decide to use the spousal loan strategy. First, you would formally establish the loan. Jack would lend $100,000 to Jill using a formal agreement that outlines all the terms of the loan. The interest rate on the loan would be 6%, which is the prescribed interest rate set by CRA. Now, Jill will use those $100,000 and invest them in income-generating assets. Since the investment generates income and the investment is in Jill's name, any taxes on the earnings made will be taxed in Jill's hands. This means a lower tax rate compared to if these investments were taxed in Jack's hands, and this is the benefit of the strategy. This can definitely get a little bit complicated, so consult with an accountant if you think the strategy would be beneficial for your family. So the interest that was paid by Jill on the loan, which was $6,000, would be tax deductible for her. However, the interest received by Jack would be taxed in his hands, just as if he were to earn interest on any bonds or savings account. Also, it's important to note that the prescribed rate can change at any time, so it's important to check that with the CRA before going forward with the strategy. I hope those tips are valuable to you. Thank you for watching and supporting, and I'll see you next time. Cheers.